What is relative strength index? And by the end of this session, you should be able to understand what is relative strength index, how to add it to chart, interpret and use the indicator. The relative strength index, or RSI for short, is a popular trading indicator used to determine the strength of a market's momentum. When the RSI indicator is above level 70, the market is overbought, and when the RSI indicator is below level 30, the market is oversold. The relative strength index tracks overbought and oversold levels by measuring the velocity of price movements. Let's look at the formula. The relative strength is calculated by dividing the average of positive price changes by the average of negative price changes, and the RSI can be obtained by subtracting 100 over 1 plus relative strength from 100. By default, the RSI is calculated based on period 14, but traders can change this according to their preferences. Now let's look at the features of this indicator and how to interpret it. This indicator has fixed range between the 0 and 100, and the RSI cannot exceed 100 level and cannot fall below 0 level. Traders usually add extra 2 more levels to indicate when the market reaches the overbought and oversold level. The extra 2 levels can be customized according to traders' preferences, but in general, level 70 usually will be overbought and level 30 will be oversold. We'll go through the RSI indicator trading technique in details on chart and also how to use it with combination with other technical indicator. Let's begin with placing the RSI indicator on chart. To place the RSI indicator on chart, there's few methods to do it. The first method is go to Insert, then Indicators. Under the oscillator, select the relative strength index. The second method will be the easiest one, as you click and drop it from the navigator panel. To do that, simply go to the navigator panel, Indicators. Under the oscillator, click the relative strength index, drag and drop it on chart. Now let's look how to use the RSI indicator in trading. There are 3 methods in which traders can use the RSI indicator during trading. They are identifying the oversold and overbought, identifying the divergence between the RSI indicator and the market, using the RSI in combination with trend indicator. Let's look one by one in detail how to use them. Overbought and oversold. The most common RSI trading strategy is to look for overbought and oversold extremes. This means that traders focus only on short position when the RSI indicator rises above level 70, and traders focus only on long position when the RSI indicator falls below the level 30. The logic behind this strategy is that when the market rallies too much, it's more likely to make a pullback. On the other hand, if the market falls too much, it's more likely to make a bounce. This method can be used only when the market is in sideways but not during trending. Just because the market has rallied too much and is overbought, it doesn't mean that the market must drop. And when the market has fallen too much and is oversold, doesn't mean that the market must rise. Let's look at this example. Market continuing to rally despite the RSI indicator indicating that the market is overbought. Bullish and bearish divergence. Mostly traders use divergence to predict tops and bottoms in the market. A bearish divergence happens when the market making higher highs but the RSI indicator makes lower highs. This indicates that the market is overextended. The rising power is minimal and signals the market may fall soon. A bullish divergence happens when the market making lower lows but the RSI indicator makes higher lows. This indicates that the market is oversold and the decline may be slowing down and signals the market may rise soon. Here are few examples of divergence signals. Combination with other indicator. The final method is to use this indicator in combination with other indicators that defines the market's trend. So how do we define the market's trend? There are many ways, but one of the easiest and most common ways is to simply look at the market's 200 moving average. This means that traders should go long when the market is above the 200 moving average, made a short-term rebound, and the RSI is below the level 30. Similarly, traders should go short when the market is below the 200 moving average, make a short-term bounce, and the RSI is above level 70. Here are few examples of combination signal.